lot of times they confuse bookkeeping with finance. And also bookkeeping in a lot of businesses is, you hand it off to somebody that's referred to you, maybe a family friend. You don't want to spend money on the bookkeeper when you start out the business, and then all of a sudden the business grows and you're still doing your bookkeeping. And then you've got a tax person that's involved once a year making changes to your journal, to your general ledger. I think one of the things they struggle with, not with that process, because that process seems to work while they're doing it.
Welcome to the Profit Answer Man podcast. We believe the purpose of business is to make lots of money. We'll show you how to scale and grow your profit and cash flow, all while working less. We're a big fan of the ELF model: easy, lucrative, and fun. If you're the backbone of America, you deserve to be well rewarded for that. Listen in to see how other business owners are doing it and how to maximize your profit and cash flow. Welcome to the Profit Answer Man, Salvatore Tirabassi. It's great to have you join us today.
Thanks, Rocky. Good to be here with a fellow Italiano.
Excited for the conversation. Can you share a little bit about yourself and your business?
Sure. I am the founder and managing director of CFO Pro Plus Analytics. We're a full service CFO services consulting business. We do what's typically called fractional CFO work, which is permanent part-time CFO function plus other layers of the financial operations if the clients need it. And then we also do interim CFO work where we typically get brought in by investment banks or private equity firms to help businesses that they're interested in selling or have recently purchased in improving their financial strategy and operations. Typical clients are across all of these is mainly family and founder-owned businesses, 3 to 100 million of revenue. And personally, I'm originally from New York. I'm a former venture capital growth equity investor who became an operator. And I kind of package all that know-how into a methodology that we deliver daily to our clients.
What do you see as the biggest struggles business owners have when it comes to the finance side?
I think that I will say it's like I'll do it on two layers. One is the kind of basic level, which is a lot of times they confuse bookkeeping with finance. And also bookkeeping in a lot of businesses is, you hand it off to somebody that's referred to you, maybe a family friend. You don't want to spend money on the bookkeeper when you start out the business, and then all of a sudden the business grows and you're still doing your bookkeeping. And then you've got, a tax person that's involved once a year making changes to your journal, to your general ledger. That's, I think, one of the things they struggle with, not with that process, because that process seems to work while they're doing it. It's really more when they lift their heads up and they sort of say, hey, I need to figure out, should I rent this new warehouse? Or, I'm not really sure that these salespeople have clients that have a cancellation rate that's as good as these other salespeople, and you start getting into these more complicated questions, and the bookkeeping is really just not the information, the core information that you need to answer those types of questions. And also the level of skill that's required is much higher. And it leads into a whole other set of questions. So at the base level, I feel like that's where entrepreneurs kind of struggle, is they get to a point where they need more information and they can't get it. And they could be, I could give you 100 questions that they could be keeping them up at night, but it's something like that. I think on the more sophisticated side, where you're dealing with companies that may have already had a CFO or have raised some debt or something like that, it's usually in the forecasting and putting together profit KPIs and metrics about how you're actually making money, developing leading indicators, trailing indicators. Those are the things that they might be missing. And again, you need, professional level expertise that has done it before to come in and really, help you solve those issues.
So I'm going to touch on a whole bunch of what you said. Journal entries are the bane of my existence. The accountants go in and make an entry, and I look at stuff, I'm like, it makes things not make sense, because all they're trying to do is make it work for their tax purposes. And so now they could put a journal entry in December, and I'm like, what happened to December sales? Oh, there's a journal entry. It's not real. It's just somebody moved money from one thing to another.
Right.
And so that happens. And I get it. The problem with bookkeeping is if you don't understand what they're doing, they're not going to set it up in a way for you that makes sense for you to extract the information that you need.
Yeah.
in the way that you need it. So the bookkeeping might be good and it might be perfect and it might be compliant, but it doesn't provide the business owner the information that they need for those questions that keep them up at night. Because nobody's waking up at night going, I wish I had a better bookkeeper. They're waking up at night going, can I afford this? Should I make this move? Will this pay off? Where's my money leaks?
Right.
And all of those things, though, what I find is they're not necessarily in the accounting system.
No, they're not.
They're in other systems.
Yeah.
And you have to pull all these disparate reports and systems together and put it on one simple dashboard so that you can see everything in one place at one time so that you can track leads to conversions to sales to making sure that everything lines up and lines up accurately for what's real. And what I mean by that is, and I'm sure you've seen this too, if you've got a business that's got cost of goods sold, whether it be manufacturing or services, if they don't do their bookkeeping to tie that expense to the revenue, stuff goes all over the place. One month they look great and the next month they look horrible.
Yeah, sure.
And it's just because
I'll give you a great example of that. If you're in the wholesale trade of some kind, selling product through retail, and you've got revenue allowances that are happening, and to explain it to the audience, like let's say you make blankets and you sell your blankets through Walmart. Walmart's buying that at a wholesale price, which is your revenue. But Walmart, in their agreement with you, might actually have certain allowances like, oh, we're going to do certain types of promotion of this through the stores and we're going to charge that back to you. You've got to meet certain, Costco's notorious for this. Like you got to like deliver the product exactly in a certain format. And if it's not, they'll charge you for that. Or if your sell-through isn't high enough at Costco, they'll charge you back for that. All those revenue allowances should be tied to the wholesale product that you shipped in that month. But what happens is the allowances aren't figured out by Costco or Walmart until it could be 6 months later. And then they're sending you a bill that is going against your revenue, but it's going against in a less sophisticated cash-oriented accounting system that an entrepreneur might be using, just going to apply the allowances to that revenue 6 months down the road. But those allowances weren't related to those revenues. They're related to the revenues from 6 months ago. And so that's where, having some sense of how accrual accounting works can help you there. But in that case, if you just did that, your gross margins would never look steady, even though you're selling blanket after blanket after blanket after blanket. Like 1 month, you'll be at a normal margin, or what seems like a normal margin. It'll probably be overstated. And 1 month, you'll have almost no margin, or maybe even negative margin, because all these allowances were being applied. That's an example of timing affecting, looking at what your gross margins are, right?
And that even happens in the simple of the businesses. If they go buy inventory and they pay for the inventory this month and they sell it next month, and then next month they don't have a cost of goods because they don't track it that way.
Right.
Then you end up with the same thing. And then people are like, why is my numbers jumping all over? This makes no sense. And then they stop looking. And so having that right set up, I think is a big key. And that's why coming back to the bookkeeping is having the setups done to get you information in a way that makes sense for you, not because you want accounting, but because you want to make good business decisions. You
Correct.
want to compare, hey, what were my chargebacks at Walmart versus Costco, and how do they compare, and where did we actually make money versus lose money, and what are the reasons, and how do I fix that going forward so I don't have these kinds of problems. Within that, though, you said two other things. Part of that is forecasting, and the other thing is KPIs. And I'm shocked at how many businesses, right now, I'm kind of towards the end of my forecasting season at the beginning of December. I want all my clients by now to know what next year is going to be. We want those things locked down so that when they start January, they're not figuring out, what am I going to do this year? It's like, we're going into January knowing what this year is going to be, and we're ready to run against it. And along with that forecasting is leading indicators and the accounting is a lagging indicator, which is the problem because by the time you get the accounting reports, I think for most business owners, they're like, yeah, that's nice, but what am I doing today for tomorrow?
Yeah. Yeah, 100%. I mean, the forecasting piece is, you know, varies from client to client in terms of the quality. It's certainly always below our level of capability. And so what we do is we really upgrade them. Sometimes we take them from nothing to this private equity grade forecasting capability. Sometimes we have to take them from like 50% to 100%. But our style of forecasting is, I use the term, it's like one model to rule them all. And we basically use one forecasting model. It's a monthly model. It goes 60 months out. So it's 5 years of forecasting and it's all driver based. Full balance sheet, cash flow statement, all your debt schedules. And, the drivers are the KPIs that we're trying to target every month. And that gets us into this rolling monthly forecast cadence that we do with our clients. So every month, at the end of the month, we do a reforecast of the next 90 days and we give them the KPIs of like, here's what you should hit if everything goes according to plan. And those are, quick conversations once the model's up and built because it's a very dynamic model and we can tweak things very easily. But that's how we typically do it. And then if there's a banker that comes in and says, hey, what is this business going to be worth? I want to do a discounted cash flow to figure out what this business is worth. We just hand them the model and we were like, this is the projection. This is what we're doing for the next 5 years. It's already built.
Now, how accurate do you think you are 5 years out?
Well, you're not, but no one is. No one is. You're just saying, look, based on the drivers and the market opportunity, this is what we think is going to happen in this business over time.
So let's look at PE grade forecasting and drivers. I'm assuming that in order to do that, number of units sold, right? Times a price, which in order to get a unit sold, you probably know your lead flow and your conversion rates.
Mm-hmm.
Are there any other metrics that you're using for that forward-looking forecasting to come
We
up?
do a full funnel. So
Okay.
you have to pick a starting point. You're either picking marketing spend or you're picking the number of sales heads that you have in the business.
Okay.
Right? You can also pick other variables, but you need a starting point. But you can say, I'm going to spend this much money on marketing and that's going to translate into these number of leads. Those number of leads are going to have this value. And in order to handle those leads, I need this many people to close the business, which is your sales force. And then now the sales will convert at a certain level. And then you've got your average booking, the value of it, and kind of how that revenue flows over time. If you pick salespeople as your starting point, then you're saying, I'm going to have this many salespeople. I know I can define that. And if I have this many salespeople, I need to feed them with this amount of people to talk to, leads. And those leads are going to cost me this amount of money to get. And then you do your conversion from there. So you could pick another starting point, but I find generally, like if you're in a services business or you're selling something that has salespeople, like forget about the company that I said earlier, which was selling blankets through Walmart. Their sales function is very different because they're not selling the blankets themselves. They're selling Walmart and Costco and these other guys. A little bit different model there. But if you're in a business where you're selling a service, SaaS, you could be, a plumber, you could be a car dealer. It's all about, getting that client and what's the funnel all the way up to that closed transaction. And I find it's easiest to start with either how much am I going to spend on marketing or how many people am I going to have that are going to be selling.
And I'm with you on it. It's basically a very simple formula. It's got a handful of metrics. It's not, I always say it's not, calculus. It's basic math. And when you do the basic math, that also drives a lot of other things, because if you do that math and you say, and let's just make up numbers here, I have to sell 1,000 units in order to hit goal. I now know to tell my production people, I need 1,000 units and this is when I need them because this is what I'm forecasting. And so now they know what they have to do to be able to deliver the 1,000 units because that's what the forecast says. And so it's
Sure.
much more than just that. But then the other point is, The business owner has to look at it and go, well, can you do 1,000 units? Like, are you mentally, physically, systems, structure able to actually sell 1,000 of whatever it is that you're doing? And where are you at today? Like, if they're at 100 today and they tell me they're going to do 1,000 next year, I'm scratching my head because I want to know
Yeah.
how you're going to grow that kind of percentage. Now, if they're at 900, well, that's 10, 12%. That's very doable. I can see that being realistic. I just find entrepreneurs are very optimistic. And when you do the math like this, we get down to realistic. Like, if you're telling me you're going from 500 units to 1,000, okay, how are we doing that? Like you talked about. Well, you have 2 salespeople now. Can they sell that? No. Oh, how many? You need 4 salespeople? Okay, where's the budget for those 2 salespeople? And is your production capability big enough to deliver the 1,000? Oh, they said they can only do 700 because the capacity's that big. Well,
Sure.
then how are you going to hit it? That like all these things go together. And I don't think people realize how much this forecasting brings the entire company on the same page.
Yeah, I would agree. I would say even if you go back to the number of salespeople you have, you even need to be sensitive to the fact of how long is it going to take you to find them? What's it going to cost to recruit them? And then how long are they going to be in training before they become fully productive? If you're dealing with more than 5 salespeople, all that math actually adds up. It's not insignificant. And so you need to really kind of think through those things in order to be able to deliver like a truly reason checked productivity number of I have this many salespeople who are actually doing the job and they can reasonably do this many deals in a month.
And I agree with you. It's understanding the timing of bringing all those people in. One of the biggest struggles I run into with them is they tend to want to hire first and sell later. And I'm like, no, 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 show me the results before we start adding the costs. Like, let's push our 2 salespeople and see if we can pick up growth because you started a new marketing campaign. And then we bring in the third person. Then we start expanding. I find too often they want to expand first, but it's field of dreams, right? Build it and they will come, but they don't always come, especially a new market offering. I want to see traction before we build it. How do you feel about that?
I have a couple of thoughts on that. One is I agree with you. I think that if you are self-funded, I would think that style of growth that you just talked about is more natural to the entrepreneur because they've kind of been doing it all along. And so if you bring some structure to it, it makes them even more effective at it. I think that if you have an entrepreneur who's not self-funded or maybe is very distracted with shiny objects, which happens. I mean, that's the nature of being an entrepreneur is, you're a risk taker and things look good. You're always an optimist. And so you can get distracted. I've seen that a lot. Who might fall into the trap that you just described. You'll be more prone to fall into the trap. I don't want to, just generalize and say it happens every time. But that's going to lead you down a path of stressing your liquidity unnecessarily. Or if you've got backers using their capital in an inefficient way. So to me, it's like, take your productivity to a stress point where you feel like you're really actually going to break because you're closing too much business, and then figure out how to leverage that into additional sales heads. The other thing I would tell you is on the hiring is that when we build out our forecasts and we get people into sort of like a disciplined path to growth, generally they end up missing the hiring plans because they can't hire as fast as they thought they could, which I always say to them is like your little bit of your slush fund.
Mm-hmm.
And occasionally you run into the issue where you have stressed it and you're like, wow, this really stinks because I don't have the people that I need. And if I had more, I could have a business growing faster. And I'm like, okay, well, that's a high class problem to have.
You know
We're
how
not
we
happy.
solve it?
How do you solve it?
We raise prices.
Okay, yeah. Sometimes you can't do that
Right.
whenever
Depending on
you want.
No, you
Especially
can't.
if you're trying to grow, if you know there's more demand there, shutting off the demand and not being able to bring in more people is a little bit of a slippery slope you might get on.
Well, you don't have to raise prices on everyone,
That's true.
but it gives you a model that allows you A, to give out bigger bonuses, right? B, it at least slows things down naturally until you get the back. I mean, clearly we're getting that back end up and rolling. I mean, that is the goal. But if we're in that tightness of the moment, it's a way to at least have a happy medium. And
Yeah.
every business is different, so you got to find the one that works right for
Yeah.
you.
Some you can't raise the prices just because you want to, but
And it's not that you're
yeah.
doing it on existing customers, it's on new
New
customers
business.
or new business or new contracts to so that you can serve your existing customers well, because that's the last thing you want to do is upset them too. So it kind of brings that in. Speaking of new customers, not every entrepreneur knows the true cost of customer acquisition. And along
Hmm.
with that, I don't know that they always spend enough time making sure their clients are happy, because it's a lot more expensive to get a new one than it is to keep one.
Right. Yeah. So I'm an active blogger and, I write, I would say probably once or twice a year on CAC, customer acquisition cost. It's a good acronym to know, and also lifetime customer value. And, with our forecasting models and the way we build them out, it's very easy for us to build, and we always do these side models where we're determining what the lifetime customer value and the CAC is. And all these models it's basically one, as I said, one model to rule them all. So you're using one source of data to track all this stuff. But, I think the trick with customer acquisition costs is you need to spend the time. Shouldn't take that long to gather the data on a representative sample of your sales across different products and have a customer acquisition cost analysis where you can look at how much did you spend on your marketing and sales and your sales overhead, and what is the revenue that you got from that. If you put those two pieces together, you more or less can get to a lifetime customer value. But the main piece is figuring out what is the CAC up front, because that's a lever you can work on immediately. Lifetime customer value, you've got more variables there. You've got pricing, retention, service delivery costs. And it's a little bit, if you're just starting out trying to optimize the value of your customers, I wouldn't start there. I would start first with customer acquisition costs, because it's much more in your control. You know how many sales heads you have, what kind of marketing spend you're going to do, what channels for marketing you're using. You need to know your different channels and how they vary in terms of performance. And also, don't forget that sales channel is also indicative of client satisfaction sometimes. If you're treading around the edges in certain channels where the acquisition is happening fast and furious, I would be careful, because you could end up with a bunch of customers who are going to cancel before they even make a payment. So you want to be thoughtful when you think about retaining your clients over time, especially if you're in a consumer-based services or SaaS business. Don't forget that the channel sometimes has a relationship with the overall customer satisfaction. You may think that the channel gets disconnected once you close the sale, but that's not true. Certain channels have higher cancellation rates than others.
And it's important to know that and to track by channel and to track by
Sure.
salespeople and everything else. Because when you have a problem, if you know exactly what those different metrics are, you can actually pinpoint where the issue is instead of blaming everything. Like, oh, our
Yeah.
salespeople aren't working. No, two of your salespeople are crushing it and two aren't. Go
Yeah.
talk to the two who aren't.
Well,
Or Facebook works and whatever, Twitter doesn't. Or Twitter
yeah.
people quit quick,
Well,
whatever it is.
also, I would say is remember that when there's a difficult piece of data that people are wrestling with and they don't understand all the variables that go into it, a lot of people just come up with their own pet theories. And you could spend a lot of time playing whack-a-mole with pet theories. And it could be that your cancellation rate is higher because the channel that they came from has a higher cancellation rate. And no one's ever thinking about that. And they'll be walking around saying, oh, the customer service isn't working, or the website's too slow, or uh, you know, where we they don't like the way that the payment portal works or something like that. You're going to run into a lot of pet theories in situations like that, and you need to step back and not play whack-a-mole with the pet theories, because 9 times out of 10 they're not the actual reason that it's happening. It's something else.
We say words talk, numbers scream. So follow the numbers, we've noticed that with our clients. They're like, we have conversation, and it's like the sales reps who were complaining the most about the other sales rep. When you started looking at the numbers, we came to realize that the complainers weren't producing, and the sales rep they were all complaining about was crushing it. And when we got the complainers out of the way, sales went through the roof.
Yeah. Well,
And
you
that's
gotta.
not out of the norm.
Yeah, I've had a situation like that. The good salespeople know who the good salespeople are, and they want to be around more good salespeople. So actually, when you eliminate the weaker performers, you actually have leads being put in and sales opportunities being put in the hands of more high quality people, but you're also recognizing the A grade value of these high performers, and they one will respect you as a business owner slash CEO decision maker more. But they'll also get a boost from the fact that that you're not going to allow lower level performers to kind of stick around, that you're there to win, and salespeople always want to win is kind of what I find.
I think that's true in all parts of the company.
Yeah,
Is
I would
we
agree with
tend
that.
to allow subpar performance because we don't want to deal with it. I know one of the things you talk about is driving employee motivation. Usually, I don't think most people put that together with fractional CFO.
Yeah. Well, our methodology is based on some key pillars that are single source of truth of data. So we don't want people having different sources of information that compete against one another. There's always one right place to look for the information. Another thing that we really focus on is equity value creation, and that really gets to the employee part that I'm going to talk about in a second. And then the third thing is due diligence readiness, which basically means that we help you build systems so that no matter who you ever want to talk to about your business, a buyer, a bank, a new executive you want to bring in, a merger acquisition that you're looking to do, you're always prepared to show like this, awesome set of data and information, and you understand your business in tremendous amount of detail, and your forecasts are really credible. But let me go back to the equity value creation. To do equity value creation, the employee motivation is a component of that to drive more value in the business. And, there's a whole conversation we could have about what role compensation plays in that. But I want to stick more to like the culture, the training, and the career opportunities that you have for people. I think you want to know who your A players are, and you want to know who your C players are. And then you need to get rid of your C players. And then your B players, you need to figure out, are they going to upgrade, or are they just going to be kind of along for the ride and maybe eventually fall out of the business? And in order to, maintain your A players, you've got to have a culture that they want to live in. And an A player is not somebody who doesn't fit your culture. You could have an A player who gets all the numbers right, but they're just universally disliked by everybody in the organization. And they look at your core values and they ignore them. Those are not really your A players. You have to figure out how to either get them on board, or they're going to be really undermining your overall objective in the organization as like an outlier. They're usually like someone in that position is usually, if they're a high performer numbers wise, but they're bad for culture, they're just disliked by everybody who's below them. And the people above them just don't know how to handle them. Other than you got to realize that you need to probably make a change. But all of that contributes to employee morale and keeping people motivated. People want fairness and consistency. They want to know what the rules are. And that's the bare minimum of what you can do.
We have a name for those people. We call them terrorists.
Yeah.
And I think hands down, you can't fix it. You can't teach people culture and values. Either they're in or they're out. And part of that though is you need to make sure you understand your culture and values that you created your culture and values and that you hire to your culture and values. Because if you don't do any of that, the terrorists create your culture and values that maybe you don't like. And
Yeah.
all of that stuff shows up in the P&L. It shows up as not great profits, but there's no line item for it.
Right.
And you got to figure that out. I can tell something's wrong with the business. I just can't figure out who the terrorist is until we dig
Right.
deep, And then we're like, and when they leave, everyone is like, thank God. I'm like, can't we just tell people to come tell us we have one of these people in the mix and they're driving everyone crazy? Either that or we don't listen. I don't know. It's one or the other.
It's Yeah, it's not easily exposed. Not easily exposed. That's probably the best way I could put it.
Well, they're very good. They sell up, they stomp down, meaning they make the people
Yeah.
above them think they're great. They don't see how much they're kind of doing below the line. And so, definitely not good.
Yeah.
Definitely not helpful. Well, if people would like to learn more about you, find out about how you can help them, what's the best way for them to do that?
Yeah, visit our website, cfoproanalytics.com. There's some great calculators on there. You can spend a little bit of time just messing around. Obviously, blog articles there. You can schedule an appointment with us to just have a quick chat. We really enjoy talking to entrepreneurs and founders about their businesses and spending a few minutes and giving them some free advice to try to understand what they're up to and what they're facing. And, if there's a fit, we can maybe continue to help them. But we're in the business of helping make businesses successful. And so it's always fun to hear about new challenges that people are facing and putting our brains together to see if we can help them out. But it's cfoproanalytics.com. And yeah, just look us up. And if you ever want to reach out, feel free to drop us a line through our schedule or on the website.
Cool. And we'll put that in the show notes. Thank you so much for joining us today.
Yeah, awesome. Thank you. Glad to be here.
Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.